Welcome back to the channel. Today we are diving into one of the most asked questions in personal finance, mutual funds vs fixed deposits. Where should you invest in 2025? If you've ever been confused between the safety of FDs and the growth potential of mutual funds, stay tuned, because by the end of this video you'll have crystal clear clarity. Let's start with fixed deposits, the go-to investment for millions of Indians. For decades, FDs have been seen as the safest bet. You put your money in, you know exactly how much interest you'll get, and at the end of the term you walk away with guaranteed returns. Sounds simple, right? But let's break this down step by step. First, returns. In 2025, most Indian banks are offering between 6% and 7.5% interest on fixed deposits. That means if you put 1 lakh rupees in a 1-year FD at 7%, you'll earn 7,000 rupees before tax. Simple math. But here's the catch, inflation in India is averaging around 5 to 6%. That means while your money is growing, its real purchasing power might not be growing by much. Second, safety and risk. This is where FDs shine. Your money is not linked to the stock market, so even if markets crash tomorrow, your FD interest is safe. Plus, deposits up to 5 lakh rupees per bank are insured by the DICGC, a government-backed safety net. For conservative investors, retirees, or anyone who simply cannot afford risk, this makes FDs very attractive. Third, liquidity. Can you break an FD before maturity? Yes, but there's a penalty. Most banks charge around 0.5 to 1% lower interest if you withdraw early. So FDs are liquid, but not as flexible as a savings account. Fourth, taxation. This is the part many investors forget. The interest you earn from FDs is fully taxable under your income slab. That means if you are in the 30% tax bracket, your effective 7% FD could become just 4.9% post-tax. Suddenly, FDs don't look that attractive anymore. Finally, real-life example. Imagine you invest 10 lakh rupees in an FD at 7% for 5 years. At the end of the term, you'd have about 14 lakh rupees before tax. Sounds good, right? But if inflation averages 6%, your 14 lakh rupees may actually buy less than your 10 lakh rupees could buy today. That's why many people say FDs are safe but don't really build wealth. So, to summarize, FDs are safe, predictable, and great for conservative investors. But they may struggle to beat inflation and their returns get hit by taxation. Now, let's switch gears and talk about mutual funds. These are not just a buzzword, they represent a diverse investment avenue that can cater to various risk appetites. In 2025, the mutual fund industry is expected to continue its robust growth trajectory, driven by evolving investment strategies and increasing participation from retail investors. But what exactly makes mutual funds stand out compared to traditional investments? First off, let's consider growth potential. Unlike FDs, mutual funds invest in the stock market, meaning your money can potentially grow at a much faster rate. Historically, equity mutual funds have generated returns averaging around 12–15% annually, compared to the stable but lower returns of fixed deposits. However, these higher returns come with increased volatility and risk. Next, diversification is a key advantage. When you invest in a mutual fund, your money is pooled together with that of other investors and spread across a variety of assets. This helps mitigate risk because not all investments will perform poorly at the same time. For instance, a large-cap mutual fund may invest in some of India's strongest companies, while mid-cap and small-cap funds offer exposure to emerging businesses with high growth potential. Investing in mutual funds also requires a keen eye on performance metrics. A fund's historical performance, expense ratio, and manager's track record are critical indicators of its reliability. Therefore, it is wise to compare different funds to see how they stack up against their peers. Additionally, reviewing regular fund updates can help you stay informed about how market changes affect your investment. By doing thorough research, you can tailor your portfolio to align more closely with your financial aspirations. Tax strategies are another vital component to contemplate when investing in mutual funds. For instance, utilizing the equity savings scheme could enhance your tax efficiency while still reaping the benefits of market exposure. Furthermore, investing through a systematic investment plan (SIP) allows for a disciplined approach, making it easier to invest without the burden of timing the market perfectly. In turn, this can lead to compounded growth and help mitigate the effects of volatility on your investments. By implementing these strategies, you not only optimize your tax situation but also position your investment for long-term stability and growth in the dynamic financial landscape of 2025. Understanding the significance of diversification cannot be overstated. By investing in various asset classes, including equity, debt, and gold, you can cushion your portfolio against volatile market swings. This strategy allows you to capture potential gains in multiple sectors while reducing the risks associated with any single investment. Moreover, keeping a balance between risky and safer options enables you to stay aligned with your risk tolerance, supporting both growth and security. As you analyze potential funds, be mindful of those that offer diverse holdings, as they often showcase resilience in fluctuating markets. However, one must be mindful of the potential drawbacks associated with diversification. Over-diversification can dilute the advantages of high-performing investments, leading to suboptimal returns. Additionally, some funds may not perform as anticipated, so always evaluate the specific sectors and assets included in the fund's portfolio. Beyond the sheer number of investments, the quality of the underlying assets remains crucial. As you establish your investment strategy, regularly reviewing performance relative to benchmarks can provide valuable insights, helping you adapt and adjust your approach to align with changing market conditions. This proactive oversight will enable you to capitalize on opportunities while managing risk more effectively, ensuring your investment journey remains focused on achieving your goals. Ultimately, investing in mutual funds offers significant versatility but requires active engagement and diligence to navigate the complexities of the market successfully. Keep educating yourself on market trends and economic shifts. This knowledge empowers you to make astute decisions and develop a robust investment plan that positions you for success in 2025 and beyond. Embracing a proactive and informed approach will enhance your confidence and effectiveness as an investor, enabling you to thrive while pursuing your financial objectives. Prioritize understanding the management fees associated with each mutual fund. A significant portion of your returns can be compromised by high expense ratios, so conducting detailed comparisons is essential. This scrutiny allows you to select funds that not only align with your investment strategy but also minimize costs effectively. Additionally, become familiar with the specific services provided through these management fees, determining their worth against potential returns. Making informed decisions regarding these charges will ultimately contribute to a healthier overall investment outcome as you pursue financial growth in the coming years. In conclusion, as you weigh the advantages and drawbacks of investing in mutual funds over fixed deposits, remember that a well-informed approach tailored to your financial goals will empower you to build a prosperous future. By prioritizing knowledge and strategy, you will navigate this investment landscape with confidence and clarity. Like, share, subscribe,